If you're someone who owes the IRS $50,000, $100,000, or even more, you may be thinking, there's no way I'm ever going to be able to pay this off. Maybe you call the IRS and they are looking for you to pay well over $1,000 a month. And you think, I don't have that type of money left each month to pay the government. Well, maybe there is a solution for you that you haven't thought of or even heard of. And it's called a partial pay installment agreement. And in some cases, it can allow you to settle your tax debt for less without filing an offer in compromise. But is it actually a good strategy for you? Well, let's break it down. Hi, I'm Bob Jablonski with Jablonski Tax Relief. I help taxpayers nationwide, particularly those owing over $50,000, navigate the IRS collection process and find their best path forward. Today, we're talking about partial pay installment agreements, or PPIAs, what they are, how they work, and when they might make sense for you. So let's get started with what a PPIA is. A partial pay installment agreement is actually exactly what it sounds like. You make monthly payments to the IRS. You are in an installment agreement, but not enough to fully pay off the debt before the collection statute expires. So the IRS, remember, only has 10 years typically to collect a tax debt from the date it's assessed. So instead of getting into a payment plan that will pay off your debt fully over that statute of limitation, you pay what you can afford each month using the IRS's calculation. And whatever is left when that 10-year window expires, well, the IRS is going to write that off. It's going to go away. So here's the key. You can't just call the IRS and say, give me a PPIA, give me a partial pay installment agreement. The IRS will only approve a PPIA if they determine that you cannot full pay through a standard installment agreement, but you can afford something. They require a full financial disclosure typically in this situation, or actually always in this situation. They're going to want information about your income, your expenses, your assets, and they're going to get this using a Form 433F if you're working with automated collections, a 433A if you're an individual working with a revenue officer, or if you're a business, they're going to want a 433B. And using that information there, they calculate your monthly disposable income using their formula, and that becomes your payment. But here's something important. The IRS is supposed to review your financial situation every few years, typically every 2 years. Don't always do it, but they're supposed to do it. So if your income increases, your payment may increase as well. So when might a PPI make sense? Well, a partial pay installment agreement can be a strong option if you have limited disposable income. You're not a good candidate for an offer in compromise, or you may want to take a look at that option. Or you're closer to the end of the 10-year collection statute because the closer you are, the bigger the payment they're going to need from you. We see this a lot of times for a large balance taxpayer because those payments are going to be very large in general. And although they may have been accumulated over a period of time, current income may not be in a place where you can afford those payments within the statute of limitations. An example might be if someone owes 120,000, maybe the IRS will calculate that at a minimum of 1,500 or even maybe several thousand considering where they are in the 10-year collection statute process. But they can only afford $500 a month according to the calculation. That's not going to be a full payment if it continues over the statute of limitation. And that's where it can make sense when you have a payment plan in place, but it's not going to fully pay it within that 10-year collection statute. So what are the pros and cons? And we've talked a little bit about these advantages already. You're going to have lower monthly payments than with a full pay installment agreement. You don't have to come up with a lump sum dollar amount to pay the IRS like you would with an offer in compromise. Your remaining balance can expire with the statute if it remains in place. If you remain at a payment amount that cannot pay the debt over the statute, it will be written off typically at the end of that 10 years. And it'll stop aggressive collection action. Even though you're not full paying, the IRS is not going to levy your bank account. They're not going to garnish your wages while you are on a partial pay installment agreement. There are a few downsides. Well, the IRS is going to continue to review your finances regularly, as we discussed. And if your income increases, your payments can increase. This doesn't stop interest and penalties. They continue to accrue while you're in a partial pay installment agreement, or actually when you're in a standard agreement as well. Typically, the IRS is going to file a federal tax lien whenever you are in a partial pay installment agreement, and you're going to have to stay fully compliant moving forward. You get out of compliance, the IRS may pull the plan from you. So remember, it's critical to remember that if your situation improves significantly financially, the IRS may push you into a full pay agreement. So one of the biggest mistakes I see from taxpayers who owe the IRS, in addition to waiting too long to resolve their issue, is that they jump into a payment plan without understanding the long-term impact. In some cases, a PPIA may be the best option for you. In others, it might actually be the wrong option when you compare it to currently not collectible status, an offer in compromise, or even a strategic use of the statute of limitations. You really need to be aware of the best option for you. So if you're someone who owes the IRS over $50,000 and you're not sure what your best option is, I recommend getting a clear strategy before committing to a plan with the IRS. There's a link below in the comments as well as in the description where you can schedule a consultation. I'll help you understand exactly where you stand and what makes the most sense for your situation.